Did you know that in the world markets, in the foreign exchange market, in the stock market, in the bond market, in other key markets, 80% of the trading volume is not created by ordinary private traders like you and me? This volume is created by institutional investors. That is, if you make a trade, 4 out of 5 times you make it against institutional big players. These are banks, hedge funds, investment companies, insurance companies, and major players in the market. They are the ones who create the bulk of the trading volume in the market. And in fact, institutional companies look at the market and participate in the market and make trades much more easily than regular private traders do. If we are talking about ordinary private traders, especially beginners, what do we see when we look at their screen? They add a bunch of technical indicators to the screen. Their chart will be completely cluttered with all sorts of lines, indicators, arrows, and so on. In fact, the large institutional players operate very differently in the market. They evaluate the market exactly as a real market, where there is demand, supply, where there are favorable or unfavorable prices for someone, where there are current trends and tendencies. And so today, I want to talk about the 3 principles of the smart money. Smart money is the name given to the large institutional players that make up the bulk of the trading volume and the bulk of the chart movement. We'll talk about how they analyze charts, what marks they mark for themselves, and how they act on market conditions. So the first thing we need to talk about is finding the points where supply and demand occurs. In order to explain this concept, let's first talk about support and resistance levels. This is a classic technical analysis tool. Theory tells us that by 2 points, we can make up a resistance or support level. These are levels where history shows at least 2 bounces have occurred before. So we're looking at a graph. The average trader will do what? He will set the resistance level, and here on these 2 points, and here he will set the support level. And in general, he will be right. According to the theory of technical analysis, this is how these levels are set. These are levels from which a rebound is likely to occur in the future. If we look at the chart, further out, it's from the lower level, it's likely to bounce. From the upper level, it's likely to bounce down. And it's very similar to the concept of supply and demand zones. If we talk about smart money, firstly, banks. Investment companies do not mark resistance and support one line. They usually consider the supply and demand zone. That's the kind of thick zone that plus or minus 50 points would be valid. Even if the chart does not reach the line or slightly crosses it, it will still be considered a bid zone because it is a price that is high for the chart on this segment. And at this price, it will definitely be profitable for someone to sell. And as we can see, every time the price approached this zone, we got sales, pending orders were triggered here, or the market went someone big and pushed prices down. Same with the support zone and the support zone level. We can see that price has bounced upwards from this level several times before, meaning there's a demand zone, meaning that someone's pending buy orders are standing here, banks, either some investment companies or hedge funds. And every time the price reaches this point, which is very low on this chart, like this, buyers appear in the market and push the price up. That said, if you study the theory of how smart manis work, they mark not only the highs and lows, they look for supply and demand areas within the chart as well. For example, we can draw an additional resistance level like this. That's under this high and low. Look, here we had a bounce from this level, and here it was delayed at least twice from this price trader sold. That is, we have a zone of absolute supply here. That is, at this price they already sell for sure, but sometimes there's a certain amount of supply that is ready to sell at a lower price. And we can build an intermediate resistance zone on these 2 points. And as you can see, the next time the chart approached it, it bounced exactly from it, not from the main offer zone. Same here. There was a major bounce here, but after that, there was another intermediate bounce. If we used only the classic resistance and support zones, we would miss half of the movement. That is, at least 3 good deals we missed, simply because we didn't utilize the intermediate offer areas. Same thing with demand. We can, for example, make an intermediate support level at this level, right? We have a once bounce from it and a second bounce from it. So even by these 2 points, we can realize that there's also a demand here too. Someone is willing to buy at that price as well. Few wait until the lowest point. Some people are ready to buy here as well. As you can see, the intermediate support zone worked here. The intermediate support zone worked here. And here's 2 times. That is at least 4 trades we could have used if we had utilized this additional intermediate level of demand. If we left only the bottom one, we would only make 2, 3, 4 trades, and all the in-between deals we would have missed. Although there's actually a lot more profit to be made here if you look at all the supply and demand points. So, what makes the concept of supply and demand zones different from resistance support levels is that the big players in the markets are not just looking at the highest points, they are looking for local demand, local supply. For example, we could even draw a zone of support, a zone of resistance right here. And at least a few times, there have been sales at those prices as well. That is, if we are talking about large companies, about smart money, they are looking for all the support and resistance zones, all the supply and demand zones on the chart, which can serve as a reference point for future trades, and based on these prices, already put their purchases. The next concept is market structure. That is, even just by looking at the chart, you can understand the market structure, how the price behaves. This chart here, what state do you think it's in? Is it a rising trend, falling trend, or flat? I won't be here for long. It's obvious to everyone that there's a falling chart here, that there's a falling trend here. But how do we know that? Just because it's falling? In fact, if there were stronger fluctuations here, and even though the price is going down, we could not say that this is a trend, because this movement is more like a flat. A market structure, such as a trend, differs from others in that local highs and lows are updated every time. So if we are talking about a falling trend, the highs and lows will go down every time. Here we have the first maximum chart fell, outlined the first minimum. Then it bounces. There's a second, the maximum is already lower than the previous one. The chart continues to fall, and we have a new low that is lower than the previous low. It is bouncing again. We are making a new local high, which is lower than the previous high and lower than this one. Then we have a chart that continues to fall. We have a new local low that is lower than all the previous ones, and so on. Here we have a new high that is lower than all previous highs. And that allows us to say we're trending here. And these local maximums and minimums are the lines of supply and demand drawn by the major market players. It's just that they will be diagonal during a trend, not horizontal as they are during a flat. That is, here the big players also realize that demand will arise along this line, that sales will appear along this line. As soon as the chart approaches it, more and more players will want to connect to the current trend, and we will now have demand zones on the diagonal instead of in a straight line. And here, we will be looking for points for trades down this line. Then the same under the demand zone, which means that our purchases will be located along the line of lows. We understand the trajectory of the lows, and we can assume that once the chart approaches this line, we can trade up. This is how we can analyze market structure. And that's the second concept of the smart money. Analyzing market structure allows you to find good supply and demand points in the market, even in trending charts. The same thing works on rising charts. We're in a localized little rising trend here. Why can we say that this one is also a trend? Because we have, again, minimums that are constantly rising. First low, second low above, third low above the second, and the highs are also updated upwards. We have a first high, a second high above the previous high, and a third high above the first two. And the task of analysts in large investment companies is precisely to determine the market structure. First, we are trending or flat, and how we in this market structure will work. The second is to determine the bid and ask prices, from which we will specifically make deals and place our pending orders. And the third concept of the smart money is the change of structure. It's kind of like if we're in this part of the chart right here, we can realize that this is a falling trend. Again, let's reinforce how we define market structure. We have updated highs, each lower than the previous one, and updated lows, each also lower than the previous one. We can confidently say that this is a falling trend, and many analysts among smart traders designate these diagonal lines as the boundaries of the current trend. And if we see a clear breakout, and we see that now the market structure has changed, now the lows and highs are updating upwards, just as they did on the previous chart, then we now have a new market structure. We now have a rising trend. And these are the two lines we can already disregard. This structure has been played out, and now we are adjusting to the new structure and making trades upwards. Why is it important for smart traders to identify market structure? If we have determined that the current market structure is a falling trend with these boundaries, then we will only look for down trades. We will not trade against the trend. We will not trade against the market. We will only look for trades in the direction of the current structure. We will adjust to the current market sentiment. Conversely, if we have a flat market and there is no clear trend up or down, we will now build off of that structure. We know we have a plus-minus stable price. And at those prices that are favorable to the majority in the market, we will also enter the market. We will move together with the smart money. So, to reiterate the whole concept, we need to define the market structure and define its boundaries, and move within the current market structure, opening trades from its boundaries. And if you learn to think the way the smart money analysts think, the way the analysts of the big players in the market think, then you will profit in many more cases. Simply because, as I said, it is the big players who do 80% of the trading volume. This is why you hear so often that private traders, especially beginners, often lose money simply because they are playing against professionals. And you need to, in order to make money, you need to think and act like a professional. And so, understanding the principles of supply and demand, understanding the principles of market structure, and changing the market structure, those principles will help you greatly improve your results.